Ton of tech problems again today, so I'm a bit delayed. Just needing my coffee now.
Right this moment, there is a mad rush in America. Apple, Amazon, Facebook does.
Back in flash. All right, good morning, good looking people. Sorry for the delay. For some reason, I had to reset the webcam and all the different scenes for this webinar. I don't know why that has to be done every so often. But anyways, good morning. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. But please, stay small, stay humble, focus on the long term, and never risk money you cannot afford, eh? So, the webcam works now. Oh, is it this thing that's throwing you off? Yeah. Sorry. So, hi, my name is Wayne McDonald. I'm a currency trader. Thank you for being part of the Forex.Today YouTube community. Today, we're going to talk about technicals and fundamentals and put together the week. I suggest we go through the calendar and that kind of stuff. So, we'll just do that. Technical analysis, fundamental analysis, go through the trade calendar. I also can answer your questions. So if you have any questions, I'll do my best to address that. So Forex.Today is a community of, what is it now? What's the number? 15,700 Forex traders around the world. So thank you for being part of that community. And if you are brand new to these webinars, please subscribe. We do these webinars every day of the month except the first Friday of the month. I'm over at FX Street to do a webinar called Trade Non-Farm Payrolls Live, which I've been doing for nearly 15 years on a monthly basis. Yeah, a monthly webinar that I've been doing for almost 15 years. Means I've been trading Forex for a while. So anyways, so please subscribe and all that kind of stuff. Also, the tip of the day is leave comments on the recordings so that you can search your comments later in the future. And if your comments are cues on what you learned, what your takeaway was, then you can do a search like relative strength exercise and be able to pull up the videos I did that taught you how to do those things, the techniques on how to do those things, and you'll be able to use these videos not just as entertainment or training, but actually as a repository or knowledge base that you can access on demand based on your own notes. So I highly recommend you document your takeaways from every video on the recordings, which means every video should have at least 1,000 comments. Usually it's like 19. Why? I don't know why. So anyways, there's my recommendation. Also, I'd like to thank our sponsor, TradersWay.com. If you're a foreign exchange broker or a foreign exchange trader, wink, 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 they're a foreign exchange broker, so maybe there's a relationship that could be had. If you like fast execution speeds, small spreads, big swaps, world-class customer service, well, then TradersWay might be the execution partner to your successful Forex trading business. And if you're not a successful Forex trading business, then that's my job. I'm going to help. Yeah, crypto, it ain't much, but it's honest work for sure, eh? You missed, but you did get it, right, Brandon? You did get it? No, I know. It's a meme. Very cool. You got it. Right on. But what, just too late or something? Yeah, I sent it out an hour early, and I had very high expectations. It took me an hour to set everything up to do the webinar, and then as soon as we got going, it started raining on me, and then I had to move, and then I moved to a different part of the house, and then I started losing internet, and just, I think internet to the house, not Wi-Fi. But anyways, so it was a real pain in the butt, but we ended up having a good time anyways. But okay. Boop, 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 boop. Yeah, so I guess we'll start here. Let's see. Aussie's weak, Euro's weak, CAD is weak, Kiwi is weak, Swissy is weak, Yen is strong, Dollar is strong, and Pound is strong. Now, one little thing that we did last week was say, hey, if we breach this, maybe there's a slight change. Okay, so I guess what we're thinking here is what if these, although just very short-term moves in the moment, what if these are important? Because we're sort of ignoring all this now, and we're asking ourselves, is this the future? Is this the sign that we've been waiting for? And the interesting thing is all of them mixed together mean risk on. Okay? Yeah, Jeff, I see that. Right? So is this risk on in the moment? Well, maybe. Okay, those are weak funding currencies, but what are people buying with it? It's not Aussie. It's not Euro. It's not CAD. It's not Kiwi. Is it really pound? I mean, I know pound strong, but I mean, right? Something else might be going on here, and I guess today we're going to try to figure that out. Okay. Oh, by the way, guys, so as far as off the charts with Wayne, that's what a lot of people were talking about earlier. I'm really tired today. I don't know why. So I just didn't. But anyways, if you would like to be invited to a webinar I've been doing on Sundays called Off the Charts with Wayne McDonald, where you bring a cocktail and a cigar maybe, and we sit and I read the newspaper and we talk about trading and investing and hedge funds and stuff, but we don't talk about trades and technicals and stuff. We talk about the sort of the business of being a professional trader. It's youtube.com/FXBootcamp. So if you're not getting invited, you should probably subscribe so you get the wink wink from YouTube. Okay? Now, to get invited, hey, good morning, Maida. To get invited to actually participate inside, you need to have, been a member of FX Bootcamp or the Swing Trading Group. So, anyways. So let's go try to figure this out. What's going on here? What's going on? Okay. So let's look at some other indicators that we've been sort of eyeballing. One of the eyeballing stuff here is Brent. And if you recall, we were looking at Norway, the Norwegian crown. See if the kroner's up or not. And we got more sideways, but still no down. Is that right, Maida? Well, I know you're a member of the Swing Trading Group and and you've gone through FX Bootcamp videos, so you should have received it. Oh, well, yeah, absolutely you do. And we want you to be part of that. So that's where it's going, Maida, to whatever your FX Bootcamp sign-up email was, that's where it would have gone through. Okay. Maybe next time I'll just send it to everybody. Like everybody. But it's a lot. It's a lot of people. All right, so anyway, so some up here would be a risk on sign, and not up means not down. Okay? You see what I mean? Okay. So up, there's two things here. We want up, and not down is the beginning of up. So whatever, we'll see. So it's not saying no, it's just not saying yes. Now, how about Bitcoin? How am I doing there? What was this, 2 weeks ago? We had a plan A and a plan B. Plan A failed, went straight down to plan B. Then we talked about the double bottom of a double bottom sitting up here. Well, I don't know if we call it a double bottom of a double bottom, but we were talking about this. off of our key levels, and then here's our zone here, okay? And I drew this in anticipation now, right? So now this is the new plan A from, looks like about Thursday of last week. And then at that time we said the second thing you would do in response to this would be the higher high, higher low. And I believe I actually did this. I said 1 is the double bottom, right? 2 is the higher high, right? Do you remember me doing this? It hadn't happened yet. And then 3 is the roll reversal, right? You guys remember this? 3. So this is 1, this is 2, and this is 3, the roll reversal. Okay. And now we're into a weekly swing long. You guys remember? You remember like it was yesterday, yeah. It was Friday, or even Thursday, really. And so now the target, okay, the target is actually here, but, you know, be cognizant of this level here, but whatever. So you're going for basically 11,500. Okay. Okay. So that one's working out. And the reason I like this one is not that I like Bitcoin per se, but it could be a sign of risk on returning, which I want to see in, you know, the other markets. Okay. Oh, On got the pullback? You got the roll reversal? Good for you. Beautifully done. Yeah, Forex is, do you get the bias pivots? Yeah, on the $5 one. Yeah. Pretty sure. What's going on? So, I'm looking at Brent, I'm looking at WTI, and I'm trying to discern what the future holds. Will the funding currencies weaken and create a trend for me to sit on for weeks? That's what we're looking at, okay? So if we go back to here, can you see all the planning I've done for you? This was sort of Wednesday and Thursday of last week, Friday of last week. And it's very similar because I'm looking for the same thing. So we were looking at Brent, we were looking at Bitcoin. It's all kind of the same thing. I'm looking for support here. You can see it, okay? And we measured it this way. Right, you see that? And then on top of that, I think you can see my giant arrow. And you can see the giant arrow like this. And then on a smaller time frame, we measured a trend inside of a trend with the idea of will it break? And if so, how does it break? You come back and you do a roll reversal. And it's a breakout trade, which means breakout, pullback, long and gone. And above this assumption, so we have this support outlined for you. You see it all there? And now what we see is a step up and a target somewhere up here. Because this green zone that I have for you right here is the buy zone. Only if you're a bull, of course, because that's from a bullish point of view. So you have last week's buy zone, which we talked about probably 10 times, some sort of support, some longer term uptrend is identified by this channel, breakout, pullback, roll reversal inside of a step up buy zone with a plausible target up here. Okay? And it took days and days and days because that started on Monday and then again Tuesday, then again Wednesday, then again Thursday. Breakout, pullback for Friday, so you got your Friday front run, and now you're assuming this. Now, you're still not on the free and clear plan, but this was the plan last week, okay? We don't know if it's still up, because this is a sell zone for bears, but you have to ask yourself, do you think it's up? Do you believe all of this? What is your plan? Okay. And then hopefully an action. What is your action plan? Okay. The aggressive target here is 42.50. You're like, I don't trade oil. Well, that's fine. But once again, we're looking for signs of risk on. Okay. So maybe some risk on, maybe some risk on, probably some risk on. Gold, not quite doing it yet. We have a plan A and plan B already written out. Okay. For the month of October. October, eh? We did this last week, planning out next month. All right, so it's not perfect. It's not perfect there. We have support identified here. I don't know why it's at that level, though. It should be here. So anyways, there's the bottom of the wick on top of this pivot, on top of that pivot, and now we're projecting this pivot. So again, if you risk on, this does not say up. In fact, this says down. If you're a bear, this is what you're going to do. So bulls, before you get all excited, you're going to need, okay, a reversal pattern. This is still technically down. So if you're bearish on gold, you would sell 19, right? 1900 without hesitation. Okay? Your stop would be above 1950. If you're a bear, that is what you would do every time. And 60% of the time, it will work every time. Right? Okay. So either a break up or a reversal. Okay. And this first wave here, I mean, we have, if you're a bull, the key level here obviously is 2000, right? So that would be the objective for the month of October, and you would probably assume a continuation through November and December. So it's how do you tiptoe into this, okay? If at all, okay? So bulls need to wait, okay? Now you could throw a trade here, keep it small, because you're betting. It's a lot less of a bet if you break, right? So it's a lot less of a bet if you're a buyer here. If you buy it here, you can do it, but it's a bet. Okay, and then once you're in the trade, then you hope that you're actually buying the exact reversal, but of course you're picking bottoms, and that strategy stinks. Okay, but it is what it is. Plan B would be continuation of risk off, and you'd get, let's say, if it's really fast. And let's say within the first 10 days of October, you find yourself at 1750, then your second chance would be at least back to the mean, right? And then maybe reversal there. Notice all of this is a bullish point of view. That's why I went through Bitcoin and Brent and WTI looking for evidence of risk on. So I'm not projecting risk on. I'm not I guess I'm anticipating risk on, but I'm not projecting it. The charts don't say it. Nothing here says this is going to be risk on. That's my decision, right? So I'm filtering. So if it would turn risk on, I'd like to see this, or I'd like to see this. But until then, I back off. There's a big difference, right? Technically, there's a lot more bearishness here than bullishness. Okay? Okay? It's sloping down. Okay? So if that changes, then I have permission to engage. XRP, we have it breaking up, pulling back, and heading up. And we have a thing going here. Okay. So inside of a range here. Cool. Right now we're at average price. Okay. Okay. It's out of position. Let me check the time frame on this. Daily. Okay, it's out of position on the daily, actually, but let's set it to weekly. Okay, it's out of position daily, it's out of position weekly. So this is a tough one to catch. In that scenario, if you're OOP, you try to ride the 4-hour 21. Now notice on the 4-hour, you're way above the 21, which is not a buy, and it's still technically bearish. So, it's out of position daily, out of position weekly, out of position on a 4-hour. That one's going to be a tricky one if you're going to buy it. Okay? You're ignoring a lot of the fundamental warnings. Not fundamental, sorry, technical warnings. Oh my God, I need more coffee. Oh, I need more coffee. It's all right. I order hundreds of Nespresso pods at a time. That's the way to do it. All right, so we can continue looking at risk on, but also I want to get the calendar going today too. So, okay, USD ZAR. This is what we're hoping for. We got our 618. We got our top. We're top of a regression channel. Yeah, we even have a sell zone. You see the sell zone? The question is, are you going to do it? Okay. That's that. So you've already had a couple of chances here to sell in today's sell zone. Okay. In fact, you might be missing like the third chance right in the last few minutes. You can see there was one last chance for you to get short. Okay. You sold it, but the pullback, stop loss, it missed my down. Sold it, but it pulled back, it stopped. All right, let's talk about that. Okay, let's talk about that for a second. By the way, if you don't know how to day trade, there's an entire course at FX Bootcamp on day trading. So I look at this, if you had traded it, if you day traded this, you would be in the trade for sure. Okay? You wouldn't have gotten knocked out. So if you got knocked out as a bear, you didn't trade properly. You didn't follow the rules of engagement. Okay? So we can clean this up a little bit, and let's go back to a standard operating procedure type thing, right? We can look at Okay, this. Okay, this is standard pivots. When you short in here, okay, your stop goes here. So no matter where you shorted, you know, at the open, on the pullback, on the double top, you know, even just now on the 5 minute, which is pretty late for a day trade, but nonetheless, right? The volatility of London Open would not have taken you out. If you sold in here and you got knocked out up here on that giant pullback, you did not follow the rules of engagement. Okay? That's why I have very specific rules of when to trade, how to trade, where to put your stop. All of that's in the day trading course. So you would be profitable right now if you had followed the rules of engagement. Most likely your lot size is too high and all that kind of stuff, right? Okay. So that can be fixed. That can be fixed. We can fix you. Okay. Here's a euro. Okay. Similar, only different. A lot less good. Okay. Because what I'm looking at here is I'm looking at, you know, these areas, and it seems to be more stepping up right now. Another way of looking at it, you know, like I can increase my price action pivots, for example. And let's measure more time. I think that might be too much. Let's calculate it now. A lot of math. Yeah, that's too much. I wanted to measure, you know, here. I can see, you know, like either way, I suppose. What I'm suggesting is you might be a bear on this pair, but it's not quite ready. Okay. So let's go back, you know, 7 trading days. 1, 2, 3, 4, 5, 6. You know, it's still more up than down. It's only sideways in the last 2 days, but that's pretty early to start throwing down big trades. Right? Oh, you sold at the open when it was positive, set the stop loss to give you profit. Okay, well, so you're saying it's a profitable trade, so it was a successful trade. I would argue that's not true. And now I'm looking at it from a lot bigger point of view, more time behind my analysis kind of thing. Meaning, small wins. I mean, winning isn't necessarily the number one thing. Now, it sounds strange, right? But what we know as the universal truth. The universal truth is that your losses should be small and your winners should be big. So if you got a small win, you're breaking one of the rules of the universal truths of trading. So you're showing me how you got into that trade and you got knocked out, and yes, it was for profit and all that kind of stuff. But I'm like, dude, how much profit did you possibly make? We haven't even had a breakout yet. Oh, well, somewhere in here you got in and then you got out and you're profitable. And like, what? You don't want a small win. Small wins are horrible because you know, when you look at your results, the averages, right? So like, here's one very, very common mistake, and I'm not saying this is you, but here's a very common mistake. Newer traders are very often worried about their winning percentages, right? So once they get into a trade, let's say they sell here, and they move their stop to +1. Okay? Now they say, no matter what happens, I'm going to have a winning trade. The problem with that is if you have, let's say, 5 out of 10 winning trades are worth 1 pip. Okay? And they're winners. They get recorded as a winner. And the other 5 winning trades are worth, let's make something up. 50 pips each. Okay? I'm not saying you have 100% wins. What I'm saying, of your winners, right? You get, right? So what is the average then? Right? So 5 of these, that's worth 250. Plus, right? So now you've made 255 trades. Okay? Yeah. And you're telling your clients when you trade, you make 25 pips. 25 and a half pips. Average. Okay? Now, what size is your average loser now? Well, you don't lose very many, but when you do, you lose, let's say your risk reward is 1-to-1. Now your average loser, okay, your average loser is 50 pips because 100% of those are negative 50, and your average winner now is 25.5. And now you're telling your clients, hey, you should invest in me. However, I lose twice as much as I win. And you know that's not going to work. But if you reverse this, and under the same conditions, now let's say half of your losers, okay, half of your losers now are negative 50, and you get 5 other trades, right, that are negative 1. What's your average loss? Negative 0.25, right? And now, because you're simply recording instead of recording +1, you're recording -1. Because I would argue, I would argue that your trade plan was not to make 1 pip. So I would regard that as a loss. If you created a trade plan that would make 50 or 100 or 200 pips or whatever, even if it was 25 pips, getting a +1 should not be recorded as a winner because there's no way that you plan to get 1 pip. That was a failed trade, recorded as a failure. So I would say instead of the percentage of winners being high, but your actual pips are low, I'd rather you record the trade that didn't work out. The trade plan that didn't work out is a negative. I want to record that as a loss. And my winners, let's say the average winner now is 50, and now my winners are twice as much as our losers. And the funny thing is nothing's changed except a failed trade plan I'm recording as -1 versus recording a failed trade plan as a +1. You'll have a winning percentage, but I'll make more money. And my track record, I think, will be more accurate and more attractive. Yeah, I got the first one, Raymond. I think you sent me one this morning. Yeah, I'll have to set up. Yeah. Well, we should talk. All right. So you see what I mean, guys? If you plan a trade and it fails, don't record it as a +1. Yes, you'll have a high winning percentage, but nobody gives a crap about that. But they will look at your risk reward scenarios and say, oh my God, right? Oh my God, your losses are double your winner, right? Like, oh my God, really? So if you have one bad week, it'll take you months to recover. Oh my God, because you never make any money. See? So if the universal truth, guys, is small losses, right, and big pluses, right? If you buy into that idea, that's a universal truth of trading, that your losses must be small, your winners must be big, then, you know, a small win like on that today's, what was it, a Bitcoin trade or whatever it was? I can't even remember what it was anymore. Was it this trade? Oh, the ZAR. Yeah, the Rand, right? This USD Rand. If you had a trade in here and you went through that and there's a winner and all that, that's not a good trade. So you can't come back and say, right? So right on, you're like, hey, well, I made money. I'm like, that's a losing trade, bro. That's a losing trade. Okay, so what you should have done is sold in here. Stop is up here, and your lot size is small, so you can afford that, so you can stay in the trade, and your target is down here. Okay? So your bare minimal acceptable performance for this trade, I would say, is down into support. So you're selling at 17, you're going for minimum 1690. Minimum 1690. But for the day, you expect 1670. You're expecting this. Your minimal acceptable performance is this. And so you're, right? And ideally, you're still in the trade. If something puts you into trouble, then at least you lock in your -1. At least record it for a loss. Okay? But don't record it as a win, because there's no way you said, I'm going to sell in here, and then inside the noise, I'm going to get out for a profit. You're like, what the hell is that? Okay? Okay, so anyways. Don't mean to be insulting about it. I mean to be, it's a big lesson to learn. Okay? Well, it's only fear because you don't have any money. So cut your lot size. Cut your lot size. If you can't afford the loss, cut your lot size. You will not find success until you can afford your losses. This is not Russian roulette. So make your lot size so small that you don't care. I mean, you care, like you trade properly, but you sell in here, you drop your stop, and you move on to a new trade. You don't even watch it. Typically what I do is, probably 18 hours later, I look at my trades. Like, where are we on that trade? Oh, we're down here. Cool. I'll move my stop to -1. Okay? I actually do -3. So I'll move my stop the next day to -3, because now I have to decide how many days do I want to let this run. Right? So if I was selling here, I might be going for 15. Right? So one day to me is almost irrelevant. One day is just to get into the trade. I'm more worried about what's going to happen the rest of the week, the rest of the month, that kind of stuff. And I want to be in it longer. And the cool thing is, the entry is always the same, and your stop's always the same. And then at some point, like 12 hours later, maybe you move your stop to break to -1, which is to me break even, because it's not a lot of. You lose 1 pip, you're like, it can't be much, right? But now you can let her run, and now you're going for big. Because you know the secret sauce here is big wins. Okay? So risking this much will never kill me, because it's such a pittance that if I get knocked out there, it's almost irrelevant. But what is relevant is this move here. So think of it like maybe this way. To the overall portfolio, a loss here, like, so I get knocked out up here. If this is a loss, the absolute loss, which means the loss relative to the entire account, is so small, it's basically invisible. You imagine that. Like, it's not even visible, it's so small. Okay? But if you're calculating internal rate of return, let's say you risked $100 real dollars on this trade, but by letting it run for 3 weeks, you turned $100 into $300. Okay? This is now the cash out of the account that you risked, and then you removed the risk, or 99% of the risk, and then you let it run. So 2 or 3 weeks later, right, you've collected which is only, let's say, 300 pips, right? So now if you collect 300 pips on this, your internal rate of return is 300% on the money that you put to risk. And so now on an absolute level, now it's tiny. It's a tiny win, but you were risking even less than that. But now you're getting yourself in situations where your internal rate of return per trade is quite profitable, but right? And the amount of risk you're taking overall for those trades are irrelevant. And now you're looking at the aggregate of all your trades. So again, if you're only making 2 trades a day, this will never work. But that's one of your problems, most likely, right? So what you need is to have more smaller trades, but with solid technical and fundamental analysis behind it. And you have on an aggregate, right? If you think about it, 60% of the time, your losses, your 60% of the time, your winners are producing an internal rate of return of 300%, and 40% of the time, your losses are so small they're irrelevant. And now you compound that over periods of time, and that makes sense. So you're going to get rich slow. As soon as you're comfortable with that, you're well on your path. Getting rich quick is a fool's errand. Pure mathematics is most people want to get rich quick, and that's why they don't do it. Okay, so it's like being like a contractor, like you build houses and stuff, right? There's 2 ideas, like you can do your job as quick as possible, or you can be a craftsman. I think when it comes to really any sort of business, and what we're doing here is business, if you're focused on providing value, in the short run, everything's expensive because you invest more time than all your competitors into doing things right. Not just doing the job, but doing things right, doing a little more, having better service, just treating people with dignity and respect is often unusual, right? Like you're just doing your job well. And on the short run, it's expensive, but by the time you retire, everybody knows you're the best in town. And everyone calls you first. So somewhere you got to go from, investing time to create more value than everyone else, and then building a business around that. And what you'll find is it's good business. But it's slow. Okay? But you have to make the choice and say, well, if I'm going to be a home builder, I'm gonna be a craftsman. People will appreciate the extra time and effort that I put into everything. Okay. All right, so what are we looking at here? The market. So we've done most of these. What do you think about euro dollar? Well, in the 5 minute, it's up. So that's good. Okay. I want you to look at this from a swing bullish point of view. Okay. Check that out. What do you think of that? We already did BTC, Cameron. We already did it. In fact, the trade plan was created last week and the week before, and now it's come to fruition. Not just the double bottom, but also a higher high. But not just the higher high, but also the higher low, so on and so forth. Cool. Golden buy signals. Keep talking to Jim, but are you calling me Jim? Because I don't see Jim's comments that you're commenting on. I think you're calling me Jim. That's all right. You can call me Jim if you want to. Yes, it's a step down for sure. That's all right. My name is Wayne. Nice to meet you. Golden Bull Signals. Yeah. No, that's all right. I prefer Jimbo, actually. All right. Yes, it is definitely a step down. Okay. But, okay, it's also a setup for October. So you have to decide, you know, is this a front run for October? Okay. You see how you combine all these? So, yeah. So, yeah, you're reading into it for sure. But by the time you wait for it to step up, it may be too late. So this is where, I don't know, you have to make a decision. There's more to it than pivot points. You're absolutely right by catching that. But your alpha would be to say, well, you know, when do you use it? When do you ignore it? Okay. So anyways. So you're looking at various things. So could it go down to 15 before it goes up? Oh, for sure. But right now you have a weekly and a monthly overlapped. Cameron Shirk says, what are your thoughts on no stop losses? That means you have no idea what you're doing. Okay? And many people will even argue that it's good to have a stop loss because you get stopped out too early and that creates a lot of your losses. That's because you don't know what you're doing. So it comes down to, if you recommend people trade without a stop, most likely you have no idea what you're doing. And it seems like Forex is chaos and random and unpredictable. And if you don't know what you're doing, that is true. It would be chaotic and unpredictable. And therefore, you would never be able to know where to have your stop. And you can get unlucky. And again, stops knock you out early. And therefore, you know, they add to so many of your losses. And it all comes down to, if you don't manage your risk properly, you actually don't know what you're doing. So it's very dangerous advice, in my humble opinion, for anyone to claim they're an expert and tell someone that's new not to use a stop loss. It would be almost negligent. That'd be like telling a high school kid learning how, getting his first car, and you're like, don't wear a seatbelt. Right? That's taking someone that just learned how to drive, they just got their driver's license, they got their first car, and you're recommending they don't wear a seatbelt. You're like, don't wear a seatbelt. Seatbelts are dangerous. They restrict you during an accident. Yeah, it would be negligent. So if someone's giving you the advice to trade without a stop, and they're giving you reasons why stops are dangerous, they don't know what they're talking about. Not only are they foolish, but they're negligent, okay, at a bare minimum. Okay? I today explained how to have stop losses properly placed, and how to afford that stop because it's far enough away, not on randomness, but at specific prices. So to afford that, you'd have to have small lot sizes. And all of that is valuable, realistic, helpful advice. Okay? So I just told someone relatively new to have a stop loss, to manage their risk and to lower their risk, right? And then the advice was further on how to, or not just to protect you from risk, but how to actually manage the stop in such a way that it's more favorable to your track record based on simple statistical analysis, right? And all of this, I think if you put it together, is reasonably advanced or complicated or thought-provoking in a positive way. So hopefully you would consider that good, valuable advice. And then that's true, then you would need to click the like button, and you should also visit TradersWay.com because they brought this into your life. Okay? So you have to thank them. Cool. So going back to this, if you expect euro dollar to be higher at the end of the year, yeah, in the next 100 days, if you expect euro dollar to be higher, this is where you would start threading the needle. Okay, this is a weekly up. This is a monthly up. This is the buying price for October. So does this step down say up? No. Yes, TradersWay offers crypto. Yes. Okay. You see that, guys? So nothing here says up, but that's where you come in. Okay? You're the one that's saying up, not the charts. So yeah, you're right. Is it dangerous to buy a step down? Yeah, but not impossible. It's plausible under the right circumstances, and you're planning the next really 5 weeks. So now you got a weekly and a monthly. When you look at them together, the confluence of your weekly and monthly trade plan, is there enough to go on to create a long position? And the argument would be, yeah, but you might argue otherwise, which is also fine because we're not arguing the up part, we're arguing the entry point. And that is absolutely just risk management, which is like my way isn't the only right way, and your way isn't wrong. Your way is also the right way. Okay? Both are correct because you're making judgment calls on risk. Okay? So I would be on a small time frame now, not a 4 hour, and I would expect some up, and then I'd expect some down, and then I'd expect some up, and then I would expect some down. And over the next few days, in the next 7 to 10 days, I would hope to see versions of this. So think of it as Elliott wave, right? 5 waves up, 5 waves down, 5 waves up, 3 wave correction, 5 waves, right? So now you're getting Elliott waves inside of Elliott waves, and that's all Elliott wave is doing is price action and Fibonacci. Oh my God, I just killed it for Elliott wave. So if Elliott wave was thinking long by the end of the year, and then Mr. Wave saw a double bottom, higher high, higher low, then he would justify this, say, count your wave as 1, 2, 3, 4, 5, 3 wave correction, 1, 2, 3, 4, 5, and now they're taking it north here. See, whether you use Elliott wave or not, whatever your technique is, it all ends up leading the same way. Now, the technique to enter the trade is generally worthless. I won't say worthless. That's too strong. But I think your opinion of where you want to be in the future is the most important thing. And then you look for the things on your chart that give you the strength and courage to do what needs to get done. And you might say, this is too risky for that scenario, Wayne. I'd rather wait till next week. Yes, 100% correct. But it doesn't mean this is wrong either. Okay? Right? Entering the trade this week has more risk associated with it, but there are ways to manage that risk. And the first thought is, if you were trading down here, will there be enough up in your short-term market conditions to at least move your stop to -3, aka remove your risk? Take a shot. Will a shot present itself in such a way that you can remove the risk? If so, take the shot. Now, if you take the shot and you don't expect, right, then don't take the shot. And if that's too risky, then wait. Wait for the up. Wait for the roll reversal. Wait for the 1, double bottom, 2, higher high, 3, roll reversal, and long it next week. That's correct too, as well, in conjunction with, or, right? They're not mutually exclusive. Anyways. Okay? It's the thought process to me that's most important. The technique, irrelevant. Okay? So you can now start guessing where the price action, or how the price action will occur. So oops, that looks a little on the fat side. Oh, that was supposed to be an eraser. All right, let's try this. Will it ever work? Okay, and then okay, that's how a bull would look at it. Okay, and you might say, I'm an Elliott wave person, so this is a 1 wave, this is a 2 wave, this is a 3 wave, this is a 4 wave, and this is my out. Oh, really? Okay. If that gives you strength to do what needs to get done, then great. Thank you, Mr. Wave. And then, of course, you'd expect a 3-wave correction and a resumption of trend. But we're also talking about that now because you'd expect this to be up for 100 days. So, of course, you'd get your 5-wave, you'd hit resistance, 3-wave correction, and then a new breakout, which would be another 1, 2, 3 wave through it, 4, and 5. Is it okay, for example, to take a 5% position on Friday? Well, 5% on anything is crazy. So I'm not sure what you're saying. Okay. You can't have a 5% losing month without eyebrows being raised. Oh my God, I need more coffee. I'm going to take a quick break. Okay, I'm going to take a quick break, like just enough to make some coffee, and then we'll continue. So let me put it on intermission. Be right back. And I think I need to reprogram my machine. All right. Okay, if we're just looking at the calendar here on the Forex.Today website, if you filter it out just for high impact, okay, we got Wednesday here, GDP, both out of the United States and Canada. But what else happens on Wednesday? Well, we also know ADP, another dumb prediction, happens on Wednesday. So Wednesday is going to be busy. Thursday, ISM manufacturing. It's not as important as services. Okay. And then here, non-farm payrolls on Friday. So let's add the medium back and see what else has been missed. Okay. And it's funny, I guess you wouldn't put it here. On Tuesday, we have the first presidential debate between President Trump and Vice President Biden. And that's most likely going to be important. Okay? Yeah, I'm tired today, Raymond. I'm not sure why. Just whatever. I got a lot going on. It's ridiculous. Sounds like a broken record, I know, but it's just crazy. You know, a billion here, a billion there, pretty soon it adds up. Yeah. Yeah, it's just funny. I just don't have enough time in the day, and then, of course, I'm tired. So anyways. So Tuesday is going to be a big day because of that, and that's likely to be a market mover. So, yeah. SNB, Swiss National Bank Quarterly Bulletin. At least it's something to read. Here's your ADP. They consider it medium, which is true. It doesn't actually do much. Okay, unemployment rate in Germany. Okay. So, like, I see these things as being overshadowed by, like, Spanish COVID 4.0, right? Like, if this whole Spanish economy gets shut down, that's going to be more important than, you know, last month's German retail sales, right? So, anyways, stuff going on there. You could do a little research on the Aussie, okay? But of course, this is all overshadowed by the potential for a new policy at the RBA in the near future. So that would be overshadowed. So that's why, you know, okay. Anyways. European Union unemployment rate, fine, you know, fine. Now, if you look in PCE and inside of that, I mean, there's interesting stuff that can be found here. Let's just do something like be a euro. I never remember how to spell bureau. B a euro. How do you spell bureau? Bureau. I still didn't of economic analysis. Like BEA.gov. I should have known that. All right. So, like, here's what you should be doing on Thursday, right? You know this, right? You could be diving through this research, but again, on Thursday is when it's going to come out. But look at all the wonderful analysis that you can get here. Boom! What does this tell you? Well, rich people live in New York and Connecticut, right? Chicago, Florida, Texas, California, and Washington State. That's where all the rich people live. Seattle, San Francisco, Dallas, Miami-ish, Chicago, and New Yorkers live in New York, New Jersey, Connecticut. Right? Anyways, it's all right there. Isn't that funny? So this is GDP throughout the United States of America, and you'll see why suddenly the Fed system was created, right? Because the economy is not the same. Okay. But anyways, you can play around with all these charts. I mean, there's just wonderful data. But we have some data coming up on Thursday that they're going to release. Okay. So GDP second quarter down. But as everyone knows, if you attended Off the Charts with Wayne McDonald last night, we also talked about housing prices are up 11%. Okay? Household net worth is up 7%. The stock market, despite the 30% decline, is up 11%, right? And yet GDP is down. So when you look at all these numbers, most people are poor and some people are rich. And the difference is the rich people own stuff. And if you own stuff, you've had a good year despite the collapse. And if you don't own stuff, you lost your job at the restaurant and you still have to find a way to pay your rent. What you should focus on is not only doing that, is finding a way that you can change your life path so that you can own stuff too. The bare minimum, you can put $50 into a mutual fund every month. Okay? But anyways, if you go to the BEA.gov, you can get the news yourself. There's stuff coming out. Where do they put their... They should tell us when this stuff comes out, like what's coming up. Anyway, how about this? International trade and investment facts. You want to do South Africa or Swaziland? Where's Swaziland? Oh, did they change the name? I'm probably a racist now because I call it something else. That's the old name. Anyways, we can do South Africa if you want. Look at this information, guys. The share of total exports and imports. exports, imports. Look at all this. It's like a report card for South Africa. Isn't this nice? Look at all this stuff. Was it ever called Swaziland at one point? What do I know? That was so long ago, and we don't call it that anymore, and it's, anyways. Oh. On says it's backwards looking. Yes, it is, but how many people in Forex know nothing about nothing? So when you're looking at trade, like, how will, like, let's say you're trading South Korean won, should you know about South Korea? Okay. Who do they trade with? That kind of stuff, so you can help predict the future. So it is backwards looking, but it's research. Okay. Right now, they're exporting more than they're importing, which you would expect for South Korea, but I would expect that for South Africa, but that's not the case. You see? So it's just like when are you on the clue train, right? Oh, here's what I want, the release schedule. Personal income and outlays, Thursday. Okay. International trade, goods and services. Okay. PCE, the stuff the Fed watches. So do you think, how about this? Here's how I think of our job. Our job is to analyze economic data so we can anticipate what the Fed will do. Where does Fed get its data? And is the Fed watching personal consumption? Are they watching international trade? Are they watching GDP? So why don't you get the same data from them? And remember, 95% of traders simply watch it on TV. PCE came out at 22.4. 22.4, did you see that? And they have no idea what any of it means. So I'd rather you have a fundamental understanding of what it means, and then, of course, what the Fed will do, because their job is to observe it and then use a policy that would have a particular impact that they're trying to create based on their dual mandate. And if you understand all of that, you're going to make money. Now, that's what George Soros would do. He can make money without even looking at a chart. Now, you're trying to be better than that, of course, but you can at least somewhere in the process of you learning how to trade Forex, start to incorporate some of this stuff. And I think you should just play with these things so that you become familiar. Okay? So, for example, 6 months ago, I said the first and second quarter of 2021, we will have huge positive GDP. So yeah, this is backward looking, but maybe it'll help you look forward if you understand what it is and how to gather it and all that. So whatever. Just food for thought. They are releasing important information on the calendar on Thursday. Okay? And you can learn things like import and export. You can learn things like GDP. You can learn things like consumption. Because remember, GDP includes consumption. So whoever BEA calculates GDP, so now you know that they're going to measure consumption and investment. You also need to calculate import and export data. Okay? Now the government is always the government. That's the budget. So BEA will tell you everything you need to know about consumption, investment, and global trade, all of which will impact the value of the US dollar. But you should ignore it. Do what everyone else does and just watch TV and say, wow, did you see that? Came out 22.4 versus 22.1 as expected. Oh my God. And off they go. $22.4 versus 22.1. That's ridiculous. Okay. Anyways. The mall. Vlogs. All right, so there's the calendar for the week. Nice. Nice. Beep, 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 doo, 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 doo. All right. So that's the market, and I guess we'll quickly look at some dollars. Okay. See? Even though this has been bullish, I've been trying to keep you aware of bearishness. And what we talked about last week, while this was all bullish, last week we talked about wanting it to be bearish. And for it to be bearish, we would have to see Brent rise. So as we saw earlier, I had a trade plan analyzing a Brent long, which would create a Noki short. And now we have a giant bearish engulfing candle. So now you might be asking yourself, will it head and shoulders? If so, that would put you probably a monthly M3 short, and therefore your target is monthly M1 if you're right. Remember, it's not predicting, it's an if-then statement. Then we will be heading down here. Oh my God, I already put that on the chart. Oh my God, I already did it. So, could be interesting, eh? So it's not that it will do that, but if it does, maybe you'll follow with some action. Okay? Joseph wants to know how to trade pivot points. First of all, Joseph, it's covered, I can't imagine how many hours in the FX Bootcamp training courses. I know it's covered in the day trading course, in the swing trading course, in the technical analysis course, there's probably another one. Oh, in the smart plans course. Am I missing one? Day trading, swing trading, technical analysis, smart plan. The original boot camp, the David Pegler's one, the original one from. So, anyways, it's all covered there, my friend, and it's in my book. So I have to start there first, Joseph, right? Yeah. Yeah, it's only $382 or something, right? Yeah. Remember, the coupon code is COVID-19. And it drops it by like $1,300 or something. Yeah, use this, Joseph. Use the coupon code COVID-19 and it drops it to $382. Okay? Yeah, And all of a sudden he's like, holy snickerstucker, what? What? Your lucky day, Joseph. Yeah, I'll show you. I'll show you. fxbootcamp.com. Okay. So you click here to begin because there's a giant button that says click here, right? So you put in your name, whatever. Let's go to step 2 and coupon code COVID 19, $382. And if you forget, I put it right here. You'd be shocked that people don't see this. You'd be shocked. People just don't see it. It's in giant button, in bold, in giant font, H1. People don't see it. But if you type it in. Now here's, I think there's a glitch, and it's interesting because it's not the programming. It's just, I think, how some of the browsers work. If you copy it and paste it in, I don't think it works. Yeah, it doesn't work. So for some reason, you have to type it. So there you go. Yeah. So learn how to plan trades. That's not there. So it's in the swing trading. It's not in fundamentals, but it's in the day trading. Introduction to Forex Trading is probably in there. Forex Trading Basics is in there. And Principles of Price Action? No, it's not in there. Okay. So anyways. Also purchase everything else that pops up after it. There's only one, Brandon. It says, do you want to join the swing trading course? That's all. There's not a bunch of, there wasn't like, have you ever been through something like that where there's like a one-time offer, a second-time offer, a third-time offer, a fourth-time, fifth-time offer, sixth time? You're like, oh my God, seriously? No. Something pops up. It's like, would you also like to join the swing trading group? Yes. Done. Oh, I see. Yeah, but it's not like I'm upselling and side selling and stuff. Yeah, do the lessons update through time. Once a year I add something. Yeah. All right, so that's that. That's that. Nice. So, like, for example, we can talk about, like, his question was, like, basically, what are pivot points? And like, okay, well, that's going to lead to an answer that's probably not that truly on the long run helpful. I think one thing to say is, what is the math behind it? Okay? And the math behind it is interesting because this thing here is a weighted mean, and that's very important. It's very important. And the reason this line, which is the central pivot, it's a weighted mean, which to use a way, because like we don't care about like the statistics per se. We want to know, like, why would you have a weighted mean versus a mean? A mean is an average, right? So what is it intended to tell people? A weighted mean is intended to tell you market sentiment at the end of the period. And that's cool, okay? So that's not in the math, but remember, math and algorithms only do what you tell them to do, so you have to know what you want and then tell the algorithm to do the calculations to tell you the information you need. Right? So, the market sentiment here is, the math is looking at the high and the low of the period. It could be a day, it could be a month, it could be a week, whatever you're measuring, okay? But if you just divided by 2, you'd get an average. But what the weighted average is telling you is that at the end of the period, was the market bullish or bearish? At the end, we don't really care about the beginning. We care about at the most recent time, did the market go more bullish or did it become bearish? And that's the market sentiment. So right now, if we close the pivots right now, we have a high, we have a low, but the close is low 2. So therefore, under these calculations, we would say the market is now more bearish than it was. Okay? And therefore, this, right, the central pivot point has dropped because of current market conditions based on most likely sentiment. The market is now bearish. See, the market was bullish, the market was bullish. Now the market is bearish, and that should reflect your future plans. Okay, and so a bear would look to do this. And that's important. Okay, so now you have to say, how did these change, and more importantly, why did these change? Okay, but then you also do, if you look at the math of what the calculations are, it's also telling you standard deviation from the mean. What is the mean, and how far did price deviate from the mean in the last period, above and below? And then you can do those calculations and say there's one standard deviation below the new mean, okay? And one standard deviation above the new mean based on what happened in the last period. Now that's just standard deviation. That's not magical information either, but it's relevant to show you sort of the volatility, if you will. Okay? And then, of course, standard deviation predicts 68% of a range. And right, that's one standard deviation. 2 standard deviations predict 95% based on what happened in the last period. So now you would say, well, what's 2 standard deviations below the weighted mean? And now, of course, I have to add this. So now it's just math. So I'm telling you the math now, right? There's the mean. Let me redo that. There's the mean. Let's do 1 standard deviation below the mean, 1 standard deviation above the mean, 2 standard deviations below the mean, 2 standard deviations above the mean. And now the last question is, what are all the m? Well, this is now calculate the distance between this and this, right? And divide by 2. What's the midpoint between 1 and 2 standard deviations? Here. What is the midpoint between this deviation? Here. What's the midpoint between the weighted central and the standard deviation above? What is the midpoint between this standard deviation and that standard deviation? Okay? And now you're really just looking at standard deviation from a weighted mean based on what actually occurred in the last period. Okay? Right? So Peter, what I'm telling you is, yes, it's all statistical analysis. And I've actually had to calculate some of these things by hand. Okay? Which is, fun. So that's the math behind it, which, by the way, what do you think? 95% of experts don't know? How many gurus do you think just simply don't know that? Or couldn't calculate it? Okay? So this is what the math is doing. And then, of course, you have to ask yourself, why do you care? And, of course, you care because you want to see a change in sentiment. And you want to know how far price would go relative to recent price action history. So you could say if you're very bearish now, very bearish, what would you do? Well, you know your sell zone. Okay? You're going to kick it off the weighted mean, which is the average lowered because of market sentiment. So you know an overbought scenario. In your bearish world, you know the overbought is the weakness. And because you're aggressive, you want 95% of the move down because you think it's very bearish. So why would you only go for 2/3 of the move? Okay? So, right? So in this case, you are predicting that this chart will drop to 1.1372. Now, someone that doesn't know what they're doing would just say, oh, 1350 or something. Well, in this case, you're saying based on statistical analysis of recent market history that incorporates a change in market sentiment, you have your entry zone and you have your exit zone, and none of it is random. You see what I mean? You see? Most people can't even do the math, yet alone understand what the math is trying to do. But if you understand what the math is trying to do, you could actually use it properly as a reasonable tool. And then, of course, you'll never get in the trap of you sold it because the pivot points told you to. Well, remember, what you do is you want to use the algorithm to get the information you need based on your own analysis. And so that's why when I do things like my classic FX bootcamp setup here that everyone should know, I adjust my MACD and I adjust my stochastics. Why? Why don't I use the standard default settings? Well, because I know what the math is doing, and I'm asking the algorithm to give me information that I want to make an informed decision. So I want to know whether the 2155 EMAs are converging or diverging. What's the standard MACD setting? 12, 16, 23 or something? I'm like, who the hell cares about those moving averages? I don't know where they came from. I don't think Gerald Appel used those ones. But for some reason, some programmer probably put something in the field, and now people make investment decisions because their MACD told them to. Well, if you don't know the math of the MACD, then stop listening to the MACD. And by the way, the MACD doesn't give advice. The MACD is just calculating based on your settings. So what do you want the MACD to tell you is the real question. What do you want your stochastic oscillator to tell you? What do you want to know? That is important, so that you can make an informed decision. If you get caught in this scenario that you made a trade because stochastics told you to, or you made a trade because MACD told you to, then you don't know how to trade. You don't even know why you're trading. That's why it's really dangerous, these EAs that people install where they tell you on all these different time frames whether you should be a bull or a bear. And I'm like, so what is the math doing? And you're like, I don't know. It just prints green arrows and red arrows. Really? And you're combining these things that you don't understand and you're hoping that this is going to make a decision for you? Like, dude, right? No. You want to know what you want to do, why you want to do it, and then you want your tools to help you make informed decisions, right? You don't want to get caught in a trap where you're relying on things to tell you what to do. It'll never work. Okay? So what do you think, Peter? Are pivot points based on statistics? So now that I explained that to you, then I created something similar. Instead of measuring past market conditions, I decided to do current price conditions. And so I made my own pivot points. So I think that makes me genius, right? Or at least good looking. One of them, I'm not sure. So now these are doing something similar. I'm asking the algorithm to tell me the average price, not the weighted. I don't really care about a weighted average. I already have my EMAs. So I'm like, tell me the average. Okay, tell me the average. So it's going to be in there somewhere. And then tell me overbought and oversold conditions. Okay. And one of the things, and when you load this, it takes maybe 20 seconds to actually hit, because it's also calculating in real time the slope of the change in the mean as we add and drop candles. So we're going to drop this candle and we're going to add this candle, and that will change the slope. Okay? How much does it go up over time? Okay, that's slope, rise over run. And sometimes the slope could be negative. Okay? And so we're looking at that as well. So it's trying to tell you, are market conditions more bullish now than bearish? And yes. And what this is also telling us is, in this situation, in the past, 95, right? This represents 95% of the projected range based on the range that has been occurring. So someone might look at this and be bullish and say, well, under these market conditions, we will revert at least to the mean, but more likely to an overbought scenario. So a bull may be looking to buy, but they already know they want to buy. And then, of course, they're going to want to incorporate this in other analysis, like oscillators would be one. Price action would be another one. So they're going to say, well, this might be interesting zone. You might add pivot points to look at markets. So based on what happened in the last period, what might be this period, you might use psych levels, this, that, and the other thing. But all it's telling you is 1 and 2 standard deviations from a sloping mean. Okay, so pivot points, for example, are just a number. Okay, typical pivot points are just a number. That would be the average. Here's 1 standard deviation below. Here's 1 standard deviation above. This is telling you 1 and 2 standard deviations above and below a sloping mean. So instead of sentiment, it's trying to predict trend. Or not predict, but observe. Not sentiment, but trend. Okay? Yes, that's exactly right. Pivot points tell you last period. Okay? Absolutely true. Right? Absolutely true. Based on what just happened in the last period, it could be yesterday, it could be last week, it could be last month, but in the change will tell you the potential change or the continuation of market sentiment. Okay? And then, of course, my pivot points, we go one step further. And so let me put this on monthly pivots now. So pivot point, position trading, pivot points. I'll put it here on Confluence. We'll do it that way. So one of the things we're looking at in my setup, and again, all this is in the training course. There's this is our current period. And these numbers, okay, these numbers, right, are all based on what happened over here. But my trading right now is all based on October's, okay? So I'm already on next week's and, well, no, I'm not on next week's, but I'm already on next month's pivot points, okay? And by probably Thursday, I'll be looking at next week's pivot points. So here's next week's pivot points, but it's Monday, so they're irrelevant to me now. But I think, I believe, based on how I trade, I believe September pivots that have influenced October's pivot, since October is later this week, I'm already on, okay? And in fact, I started last week basing trade plans on the October pivots, which don't exist yet. But I'm acting as if they do, and I'm incorporating that because I'm always planning the future. I'm not basing stuff on the past. I'm always on tomorrow. I'm always on next week. I'm always on next month. So if I could look at that, I would say, let's delete this. If I was bullish, this is a great buying price for me. 116.50. I already know that. We already talked about it last week. Okay, that's where bulls would buy, but I've already explained to you this is where bears would exit. So these bearish exits will create green candles, which then could give the strength to bulls to buy. I don't know if they will, but that's the plan. So if I were me on this, as I explained last week, would already be on day trading bullishly. What does that mean? That means today's buy zone was here, and I told you that last week. And I drew it. I said this area is where bears would exit. This area here is where bulls would buy, and all that. And so what you should start doing now is day trading this north and look for step ups. So today you could have bought it, you'd be making money. And tomorrow and the next day, and all of a sudden you'll be in October and you're already up 100 pips. So this is an October buy price, and this is a September exit. So, right? So that's an October entry, and this is a September exit. You see? So I like to be predictive. Okay? And so last week you can see there's nothing on this chart that says up. I know. That's your job. You're the one to say, okay, I see it's down, 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 but there's reasoning to expect that if it is going to go up, then that's how you do it. And that's your job, the predictive part. Or at the very least, right, be trading this and anticipating stopping. So I wrote a magazine article many years ago, and I said the difference between a good trader and a great trader, good versus great, is knowing to stop trading right in here. Okay? A good trader will down, 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 up, up, sell, down, 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 up, sell, down, 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 up, sell, down, 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 up, sell, down, and they would sell, and it would take one or two losses. So you make 1, 2, 3, 4 trades in a row that are winners, and then you give 2 back as a loser, or at least 1. And what you'll find is, because you traded one or too many trades, you give back 30 to 50% of your profits. So a great trader is the one that sees the beginning of the trade, takes this one, takes this one, takes this one, and is out. Why? That's exactly what the pivot points are telling you. And you knew it up here that that's where you would stop. And so now you got 4 winners and you stop trading. You didn't waste your time in the market. I give you the example that you should donate your time to be a docent at a museum and teach children about fine art or something. And but you're done. You're not in the market. You're not wasting your time staring at the charts. You got your winners. You didn't pick up the losers. So you work less, you trade less, you make less trades, and you make more money. And you make significantly more money because you know when to trade and you know when to stop. And you knew it up here, that this would be your stop. Like stop trading, not your stop loss, not your, just stop trading. It's over, it's done, September's dead. And if you're a bear for October, you know, as I've already showed you, that there's a new sell zone up here in which you would look for your evidence and then do it again. So you might have to wait and not trade for a week or two. You might have to go 7 to 8 to 10 days without trading. Oh, I know, right? So what are you doing? The things you love. Okay? It was at a magazine that now is defunct. It was called Your Trading Edge magazine. And it was published in out of Australia, but distributed throughout Asia and the Middle East. So you could pick it up in Australia, you could pick it up in Malaysia or Singapore, Hong Kong, and then they I think in Dubai and Jordan, right? So UAE, Jordan, Bahrain probably, and a couple other places, Qatar. And that was that. And then during what, some crisis, I don't know which crisis, it went out of business. But I do have, I wrote 2 cover articles. And it was on entries and exits. The first one was called Forex Entries, and the other one was called Forex Exits. So anyways. There you go. Your Trading Edge. That's right. What did I say it right? Your Trading Edge? Yeah, but anyways, that's what it was. Cool. All right, so it's been a couple hours, I think. Thank you for your time. Thank you for the investment of your time. I know your time is valuable, and you chose to be here. I hope you got a great return on your investment. Thank you to TradersWay for being a wonderful brokerage for Forex traders. If you're a Forex trader, please give them an opportunity to earn your loyalty and respect. Just visit TradersWay.com, open up a demo account. Okay. If you need other resources like chart templates, my book, my training courses, that kind of stuff, all those links are in the description below. And like I showed you today, it's 76.4% off, so it's a good discount. So all that kind of stuff, I'll be here every single day. I'll be here tomorrow. I'll be here the next day. I'll be here the next day. But the day after that, on Friday, I'll be at FXStreet.com, where I've been doing that webinar on a monthly basis for 15 years. So thank you for all you do. I'll see you tomorrow. Well,